Welcome back. You're with us here on Market Check. 82.67. So, the recovery continues a little bit more. So, from the lows of 82.40-ish, we are back at about 82.68 now. So 37 points from Friday's close. Mr. Vellayan Subbiah is Managing Director with Cholamandalam Investment and Finance Company Limited, and he joins us on a phone line from Chennai. Now, Cholamandalam reported numbers, profits of 135 crores for the quarter. That's up about 49% compared to same period last year. Mr. Subbiah, thank you very much for your time. The numbers look pretty good, and especially given the backdrop, which is quite challenging.
Yeah, thanks Prashant. Thanks. Yes, it's been a great quarter for us. I agree, the backdrop has been quite challenging. The good thing is that we started investing heavily on improving our collections performance at the beginning of the financial year last year, and we're definitely seeing that pay off kind of dividends in terms of what we saw last quarter.
And how is it going to proceed from here? I mean, the focus on collections.
Yeah. So the focus on collections, Prashant,
is the momentum on basically. Yeah.
Yeah. So definitely it's been good momentum. For the last 5 months, we've seen significant improvements on roll forward rates, which gives us very good comfort in terms of going into this financial year. And we're not going to take our intensity kind of off the collections pedal. Because we need to see much more improvement in terms of the portfolio performance overall. But as we go into this year, I think that improved collections performance hopefully will be also coupled with reduced cost of funds. And I think both of those levers in itself is sufficient to make this financial year a fairly good performing year. And if we can get any additional benefit from increased demand and disbursement, I think that's only a bonus. But just the other two levers in itself are sufficient to make this year to be hopefully a good performing year for the company.
Can you talk about credit costs and how that panned out? Give us some color.
Yeah, so if you take our GNPAs overall, Prashant, basically we saw the two things that happened, as you probably read from the footnotes. We've moved our provisioning from 6 months provisioning to 5 months provisioning. That's 1 year ahead of what the RBI wanted us to do, because the RBI wants us to move at the end of this financial year. But we took the call that from a prudent perspective that we'll make that adjustment kind of 1 year ahead. But on a like-for-like basis on GNPAs, we've seen almost about a 35 to 40 bip drop on GNPAs between December 14 and March 2015. Obviously, kind of given the fact that the provisioning basis changed, then we've seen a slight increase in GNPAs because of the change in provisioning basis.
What's the timeline, by the way, for you said you already compliant with the 5 month? It was 6 months earlier. DPD NPL norms. You've complied 5 months and.
Yeah. So basically, Prashant, the requirement was that as on our March 2016 balance sheet, we were expected to go to 5 months. March 2017 balance sheet to 4. And March 2018 balance sheet to 3. So we've made the adjustment 1 year ahead in terms of the movement to the 5 month requirement.
Fair enough. Got that. So I mean, if you're going to move faster towards you're going to be ahead of schedule in terms of complying with what the RBI wants. Credit costs, etc., will continue to remain high?
But obviously, Prashant, what we will require from the overall community is to kind of take a bit of a review on what expected credit costs are going to be. Because obviously, if you move from 180 to 90, your GNPA levels will go up. Right? So that is to be expected. Obviously, we're doing a lot to try and contain that number and kind of keep it at manageable levels. But as the community overall, kind of as all of the vehicle finance lenders move from 180 to 90, yes, we will see an increase in overall GNPA.
Right. Could you talk about loan growth and what is your strategy there?
Yeah. So I think the the perspective I've always taken is that we need 3 months of improved collections performance before we grow the book. The good news is now we've seen 5 months of improved collections performance. And so we are getting more comfortable with growing the book. We are seeing growth in the medium and heavy commercial vehicle portfolio. So sequentially, quarter on quarter, we saw 16% growth in new trucks dispersed and a 10% growth in old trucks dispersed. That's a sequential Q4 versus Q3 comparison. That's also so what we have to now see is how the market begins to play out in the current quarter that we're in. But we do feel that we are open to loan growth, provided that we kind of it sticks with the credit norms that we've got in place, which are obviously tighter than what they used to be kind of in the past.
Right. Was that for all the segments? I mean, passenger car, etc. All segments, or you were just talking about the commercial vehicle, M&HCV?
It is for all segments, Prashant, but basically, as you know, we're not very big in passenger car. Our largest segments are light commercial vehicles and then small commercial vehicles, mini light. But we do see and do expect that trend now. So, in general, what I see is that when growth comes into medium and heavy commercial vehicles, there tends to be at least about a 6 months to 1 year lag. Even the slump basically for light and mini lights was basically 1 year behind the slump for medium and heavy. So, I do think there'll be a lag in terms of demand pickup. But when the demand picks up, we're definitely ready to support that growth from a market perspective.
Fair enough. Good luck, sir. Thank you very much for joining us with that perspective, Mr. Subbiah. Thank you. Okay, let's take a quick break. Just coming back in 2 minutes.